Will European policymakers be able to strike a deal and manage their debt load? And how will conditions in Europe continue to affect your investments, perhaps in the United States? My guest to help us answer these questions, Douglas Borthwick, Managing Director, Head of Foreign Exchange Trading at Faros Trading. Also with us, we've got Chuck Lieberman, Chief Investment Officer at Advisors Capital Management. Gentlemen, good to have you with us. Douglas, let's start first with you. You've been long the euro. You've been bullish on the euro. Do you think that the Europeans have finally got the message from Standard & Poor's this week, and they're going to put through some kind of deal?
I think there's a lot of pressure, and the pressure continues right now. I think that Germany's still waiting on a couple of holdouts before they really sort of let the floodgates go. The floodgates, in our mind, are the IMF deal that seems to be no one's talking about, but essentially we believe that there's a European monetary fund that will be created. The European central banks have all talked about they want to put money into the European fund within the IMF. We believe that that fund is being built. There are countries that are now saying they will put money in towards that. And what will that be used for? That'll be used essentially as the fire break. And that's for if you can't raise money in the open market, you can come to the IMF and you can raise money here at 4 to 5%. So we believe that that's sort of one piece of the pie that isn't there right now. We think that the EFSF will be used for reshoring up banks. We've talked about here about $150 billion, where the EFSF can easily handle that. And the ESM, if brought forward to June of 2012, well, that'll be able to take care of the local debt that's trading right now in the market. So we believe that there is a plan in place, but no one wants to really agree and say there is one up until everyone agrees to treaty changes, which are needed for any of these plans to come into being.
Also want to bring in Chuck Lieberman, Chief Investment Officer, Advisors Capital Management. Chuck, good to have you with us. So explain, if it's possible, why is it that U.S. stocks, companies in the United States, all they do is seem to trade off news coming out of Europe? Is that connection really valid?
Well, there are two connections. One is one that's totally wrong, which is the notion that there's a recession in Europe, there must be a recession in the U.S. The impact of the European economy in the U.S. is too minor to really even notice. The bigger issue is contagion. If there's a credit meltdown in Europe, and people remember the credit meltdown that occurred in the United States in 2008. So they're very sensitive to this. And the logic is, if there's one in Europe now, because the Europeans can't get their act together, then we can't escape. And that spillover will hurt our markets and hurt our economy and hurt our equity markets as well.
Yeah, but I mean, central banks around the world have made it clear that they are going to provide the liquidity and that they are aware of the potential problems that would exist if indeed, as you described, there is some kind of financial debacle that takes place in Europe. So if that's the case, why wouldn't people just say, all right, central banks, they're going to add liquidity, let's go long stocks?
Well, that's what they really should do, and I think the path of least resistance ultimately is upward for the U.S. stock market. But the fact of the matter is that there's a dance going on in Europe. The European Central Bank basically sends out messages, we're not going to buy sovereign debt, in order to put as much pressure on the European governments to commit to reducing their budget deficits. So they get a little closer to the edge of the precipice. That scares the market, and we react. And of course, then those governments react by knuckling under, throwing in some benefits, saying, yeah, we are going to raise taxes, we are going to cut spending, and then the markets rally. And then they don't commit, they don't follow through on the commitment. So again, we go through this dance once again. We need a deal in Europe that resolves all of the issues, puts capital into the banks, exactly as was suggested just a few minutes ago. That needs to be resolved. Once that happens, then I think our markets do much, much better.
All right, so where do you allocate capital right now in order to take advantage of those future moves?
Well, I think you have to be sensitive to the fact that given the battle that's taking place politically in Europe, you really want to buy on dips. And the parts of the market that are most attractive are the ones that are sensitive to the economy, the economically sensitive ones. If you have the backbone, then you might consider the financials. Obviously, that requires a lot of backbone. But some of the consumer discretionary companies, the industrial companies, very attractive valuations.
Douglas Borthwick, you've got some backbone. You've been talking about being long the euro.
Yep.
And you think that people are missing the context of what's going to happen to the euro, that it is a proxy not only for Europe, but it is more importantly a proxy for the D-mark for Germany?
I'll give you a plug here for Bloomberg. If you do a GIP 65 on the euro, you'll find that over the past 65 days, the euro's really hung in around this level. Started at 133, still at 133. The low's been 132 and the high's been 142. So being short it's not winning. It's really losing right now. And in my belief, there's so much negativity poured into this trade that if anything, you're going to see a big bounce in the euro much higher. Now, how much is that? Well, when you look at the risk reversals, the 25 delta risk reversals in the 3-month.
What's a 25 delta
it's
risk
the price
reversal?
Of a put versus the price of a call.
Okay.
That
bullish bet versus a bearish bet.
It was 4.3 vols, and now it's 3.5 vols. It's really, come much lower. I mean, people have been taking off their risk on the downside in the euro. Maybe they've been putting on cash instead. But it seems that there's a big move. The last time we saw a big move like this, the euro within a couple of weeks moved up 7 to 10 big figures. We've seen the same sort of thing as well with yields. Yields have come off considerably on the European peripheral. Be it in Italy or Spain, they were up again. The yields were higher today, but we're down from 7.5 to around 6, 6.5 now in Italy. And the last time you saw big moves like that, the euro also moved up this 7 to 10 big figures. So if anything, the euro, I used to ask all the time, why isn't the euro going lower? I think the question now is, why hasn't the euro jumped higher? And I think the reason is because people don't want to put the position on. It's a very binary event we're looking at here. It's either great news or it's either good news and muddling through, or it's really bad news. And in that risk-reward situation, no one wants to be long the euro at these points.
And joining us now, we have Ragen Stienke. He is a vice president and portfolio manager at Westwood Holdings Group, where he helps oversee $10 billion. His WHG small and mid-cap fund has outperformed 98% of its peers over the past 5 years. Good to have you with us. Thanks for joining us.
Great to be here. Thank you.
Explain a little bit about the fund, just so people understand the perspective. Small and mid-cap stocks,
Sure.
How have they been reacting to news out of Europe?
Well, small and mid-cap stocks have reacted the same way as all stocks, I suppose, with incredible volatility and high correlation. But the reality is we think we're in a sweet spot of investing. We invest from about 100 million up to 15 billion. So we can buy stocks when they're still inefficient from a information perspective, and then hold those as they grow and their products become more mature.
All right, Douglas, you heard about this idea, this information perspective. I want to pick up on that and talk a little bit about the news coming out of Europe. When you read the information that seems to flow from Europe, do you get the impression that many people really do not have access to many of the policymakers in Europe, and they're just kind of making it up as they go along?
Absolutely. I think the majority of the market takes their views of what's going on in Europe from what they read in the newspaper or what they see on television over 5 minutes. I think that if you actually listen to the policymakers, read the speeches, talk to them, then obviously you'll get a different opinion than what you're hearing otherwise from the media.
Because you don't get the impression that any country is going to leave the Eurozone soon.
None whatsoever. The only place I've heard that or read about that is in a column. I haven't actually heard anything like that from the ECB. I've heard it from no policymakers, no finance ministers, no economics ministers.
It makes no sense to leave the euro. It doesn't accomplish anything.
Right, because the debts would still be denominated in euros, even though you'd end up with maybe a local currency, but how would you pay off any of your debts?
Precisely, and if you renounce the euro as the obligation and you switch it over to the drachma, just to pick an example, then who would want to buy your debt?
Chuck Lieberman, you worked at the New York Federal Reserve, so you have a little bit of an understanding of the mentality of the people at the Federal Reserve, but also maybe at the U.S. Treasury. Timothy Geithner, spending a lot of time in Europe, you get the impression that leaders, not only political leaders, but central bank leaders, they're very committed to seeing a resolution.
Yeah, but I don't understand why Geithner is going to Europe. It's not his place. The Europeans, as I understand it, are not very happy to see him. I think they're right, probably not to be happy to see him. The United States should not be meddling in this particular episode. Yes, we have interests. Obviously, if Europe melts down, that's a very, very large concern. It will affect us. But the Europeans understand that. They have a very strong incentive to get this thing fixed, and ultimately, I think they will. Geithner doesn't need to be on their tail encouraging them.
Ragen, I want to talk about some specific stocks because maybe people can take advantage of these market volatility that exists. One of them, Navistar International, Timken, formerly Timken Roller Bearing, and also Western Digital.
Yes.
What are the characteristics of those stocks that you like, and why would people want to buy them now?
Absolutely. And what we're looking for, not just in those three stocks, but in stocks in general now, is that in a time of high volatility and high correlation, which we've talked about, what you see is all stocks tend to move together, and entire sectors and news coming out of Europe move stocks because of news flow on long-term problems with short-term news flow. So what we're doing is looking at underlying fundamental data, such as truck orders and what that looks like in aggregate in the U.S., And the reality is that orders have been accelerating, and backlog is becoming a bigger and bigger number, which means not only will Navistar have better visibility into its earnings going forward, but it'll get better pricing on that. And so while the stock is coming in with many of the other producer durables and the other economically sensitive stocks, the reality is that its fundamental prospects are actually getting better. Western Digital is another great stock for this environment. The reality is that it's trading at less than 5 times earnings. There was some disruption in the supply chain within Thailand.
The flooding in Thailand,
exactly. Right. And so the market doesn't fully appreciate what that's going to do to a supply chain that was already tight, inventory that was already lean. It'll be at least this summer before we get back to normal operations. The reality is that pricing within those products is growing quite rapidly, even at their best customers. And this is an industry that went from over 100 producers back in the late 80s to now down to 3. So we believe that going forward, that even in the leanest of times, the worst of the economic cycles, that we're going to have much more rational pricing by all of the suppliers.
Chuck Lieberman, it sounds like he's buying businesses. Is that the right way to approach investments? You buy businesses. You don't necessarily just buy the market.
No, absolutely. That's how we look at the market. My only question about Western Digital is that market, the drive market, is obviously being slowly eroded as people shift into other types of products. So that's a tough part of their business.
Flash memory versus perhaps disk drives.
Versus disk drives. But I completely agree on the truck story. We have a lot of exposure at our firm to the transportation industry, the auto sector, parts suppliers. We're still producing cars at a level below the rate at which we junk cars. There's a lot of potential.
I want to thank you, gentlemen, very much. Chuck Lieberman, as always, from Advisors Capital Management. Ragen Stienke joining us from WHG Small and Mid Cap Fund. And, of course, Douglas Borthwick from Faros Trading. Thanks for your views.